Welcome back. Today we're going to be talking about corporations, the organization of a corporation, as well as how to handle the stock transactions and dividends, along with their related journal entries. So to start off with, let's talk about what a corporation is. A corporation, well, I'm going to read from you guys. A corporation is a legal entity distinct and separate from the individuals who create and operate it. As a legal entity, a corporation may acquire, own, and dispose of a property in its own name. So for all intents and purposes, once you create a corporation, it is its own being. It exists with or without the original owners, and it can enter into contracts, it can sue, it can be sued. So for all intents and purposes, it's almost as if you created your very own entity, as it says. A corporation is owned by stockholders or shareholders. You can refer to it as either. It's basically the same thing. It's easy to own a piece of a corporation. All you have to simply do is buy a share of stock. So if you really had a love of Disney, then you really wanted to be an owner of Disney, then you would just simply buy a share of stock, and you are a partial owner of Disney. Now, if you're buying a share of stock in Disney, then you're buying into a public corporation. And that is easy to buy. You just simply buy something from the New York Stock Exchange or any stock exchange, and you are an owner of that type of a company. It's a publicly traded company. On the other hand, you could also have stock in a private corporation, which is basically just not publicly traded. And we'll talk about this limited liability concept in a second. Excuse me. Now, you have certain rights as a shareholder. And one of those rights that you have is you have the right to elect a board of directors. You don't have a lot of rights as a shareholder, but this is one of your primary ones. The idea is that you get to elect, you get to vote for who you want to be the ones to basically decide who's running your company. The board of directors, you're sent out a vote if you. Okay, so once you have decided who your board of directors is going to be, the board of directors from that point, they're the ones who select who's going to be all of your other officers. Your CEO, Chief Executive Officer, your CIO, Chief Information Officer, CTO, Chief Technology Officer, and of course the all-important one, CFO, which would be your Chief Financial Officer, which we would care about the most, being accountants. There are any number of them. There's also COO, Chief Operating Officer. I'm just talking off the top of my head here, but there's any number of them. The idea is that once you vote for that board of directors, you're going to put people in the position that are going to hire the officers that you would like to run the company. So if you want a nice, environmentally friendly company, then the board of directors you're going to choose is going to be people that are environmentally conscious. And hopefully from there, the people that they hire, in turn, the officers to actually do the running of your company, are also going to be environmentally conscious. Those are the kinds of things you're going to want to think about, especially if you're a majority or a significant shareholder and you've got a lot of money tied up in a corporation. You would care a lot more about who's going to be on the board of directors than somebody who maybe owns one share of stock. Okay. So in order, the idea is that the stockholders elect the board of directors. The board of directors then hire those officers, and the officers from that point, they hire the employees of the company. They do all of the actual running of your company. Now let's talk about some of I'd like to actually just jump ahead to the advantages and disadvantages of the corporation. The idea is a corporation has its own separate legal existence, which I already mentioned, separate from its owners. So once this corporation is begun, it is its own creature, its own being, its own entity. Like I said, it can sue, it can be sued, it can enter into contracts, it can break contracts, so on and so forth. One of the other major advantages of a corporation is that it has a continuous life. That means that once you start a corporation, it's going to continue forever as long as it continues to be, to make money and exist financially. The original owners don't have to be alive for a corporation to continue. Think about Kellogg's, the cornflakes. Certainly, Kellogg's started more than a lifetime ago. Kellogg's has been around. I should probably know this since I use this as my example, but I'd have to say Kellogg's has been around for well over 100 years at this point. Certainly, the original owners are long since gone, but Kellogg's continues to be around. Raising large amounts of capital. I joke in class that it is a lot easier for a corporation to go to a bank and maybe get a loan or anything along those lines than it would be for me to walk in and just say, "Hi, I'm Anne Marie Anderson, and can I have $10,000?" Corporation's going to be a little bit valued a little bit higher by the bank, the corporate entity. In addition to that, it also has a corporation has another opportunity for raising large amounts of capital, and that would be to they can sell stock shares, which is something we are going to talk about a lot in a few minutes. A corporation can sell stock in order to raise large amounts of capital in business, and it can also issue notes, not issue notes, I'm sorry, issue bonds, which are very similar to notes in the sense of a bond is as if you are borrowing money for a long period of time, and we'll talk about that again also in the future. So a corporation can raise large amounts of capital. By capital they mean money, from the shareholders. Ownership rights are easily transferable. Now, this is a good thing. Now, if I didn't want to have a Disney share anymore, if I was a Disney owner, right, that was the example we were using, was buying Disney stock, and I decided I didn't want to be an owner of Disney World anymore, how am I no longer an owner? I simply sell my stock. All right, so the transferability of ownership is very easy. It's just a simple matter of buying or selling the stock. Limited liability. This is the single biggest advantage of being in a corporation. Now, the idea is that if I am an owner of a corporation, the most I could lose if that corporation were to fail would be the amount of money that I've put into the corporation. So, for example, let's say my business goes under and it's a corporation. We'll use my donut business that I always joke about. If I had a donut business and it failed. Bankruptcy failed miserably, and I wound up being in a situation where I couldn't pay all of my bills. Well, the most I could lose would be the money that I've put into the corporation. The people that I still owe money to can't go after me or my house or my family or anything along those lines. So that's called limited liability. A more extreme example of that would be what if I was selling donuts and something terrible happened? Glass found their way into donuts. Now, this has happened in the past. I believe glass has found its way into baby food jars in the past, way back when I was much younger. But that's actually a valid example. So if that were to happen, let's just say that glass found their way into my donuts and somebody ate them and somebody died. Now, unless I intentionally, maliciously put that glass into the baby food jar, not baby food jar, into the donut, then if it was just an accident, then the most that could happen would be my corporation would be sued and possibly go under from being sued for so much money if I owed so much. But they couldn't come after me personally. Now, like I said, if it was malicious and I was doing it on purpose, well, then that's criminal. That would probably be attempted murder, and in which case they could come after me personally. Okay. The disadvantages of the corporate form, major disadvantages, is the owner is separate from management. And what that means is you are the owner as a shareholder, but you don't actually make any decisions beyond any major decisions beyond electing that board of directors. You're putting that board of directors in charge for you to make decisions about who should be, CEO and such, and the CEOs are then making the decision about running the business. So getting back to that share of Disney stock, if I own a share of Disney stock, and I went to Disney World and I decided I didn't like the way Aladdin looked on the Aladdin ride, and I thought his hat should look different. I don't know, I'm just making this up as I go along. I could call Disney and complain, sure, but they're not going to care that, I, Anne Marie Anderson, who owns one share of Disney stock, is complaining about the way they're running their business. All right? The idea is that you make very limited decisions. They are important ones, but you make limited decisions. You're not actually deciding how the company is going to be run as a shareholder. Okay, regulatory costs. Of course, it costs money to, run a corporation, to be in a corporation. You have to be, if you're public, you have to be audited. You have to comply with Sarbanes-Oxley. There's additional costs involved with being part of a corporation. And the single biggest disadvantage is the double taxation of dividends. And what that means, let me give you an example for that. Let's say you're a corporation and you have $1 million in net income this year, and at a 30% tax rate, you're going to pay $300,000 in taxes on that money, right? So you've got $1 million of net income, $300,000 of taxes, so you're going to have $700,000 left over after you pay your tax bill. Now, what happens here is you decide, as a company, that you have $700,000, and what you're going to do is you're going to pay out dividends to all of your shareholders because they've been such great shareholders. So you're going to pay out dividends to those shareholders. And when those shareholders get those dividends, first of all, they say, yay, we have dividends. But second of all, when those shareholders go to file their individual tax returns, they're going to have to pay additional taxes on those dividends. They're going to have to pay, personal income taxes on those dividends. So that same $1 million in earnings got taxed first at the corporate level and then at the individual level, which in turn is the double taxation of dividends. All right.